Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Ben Leybovich and Sam Grooms. Thanks for being on the show, guys.
Thanks for having us, Whitney.
Thanks for having us.
Yeah,
this is fun.
Yeah, I'm excited to have you all, and I know you all are the guys making it happen. Isn't that right, Ben?
Oh, we do a few things here and there.
Yeah.
We're quite bashful, you know.
I don't think bashful is a way to describe Ben.
So these guys have been investing in multifamily for a long time. They're great syndicators. They're making it happen. I'm looking forward to getting into this conversation. But Ben and Sam, let's get started a little bit give us a little update on what you're working on right now, and maybe briefly tell us what you've done up to this point in the syndication business, and then let's dive right in.
The last podcast Sam and I recorded, I was playing back the podcast with my wife. I happened to be in the car. She just looked at me and said, "You sound like such an ass." So today, because this is a family show and because you got a reputation to protect, I'm just going to behave myself. And the first way in which I'm going to do that is I will allow Sam to go first.
Well, thank you, Ben. So in the last 6 months, we bought 215 units split between two properties. What is it, about $11 million purchase price? We raised about $8 million for those two deals.
The purchase price is about $20 million. Purchase price is $20 million.
19.
11 million. One of them was 11 million. Right? So we raised what? 4.5 for one, 3.5 for the other one. Good deals.
Nice. So tell us, what is your model right now, your structure of your partnership between, Ben and Sam, and what are your roles?
I'm
So we both underwrite. We get a deal from brokers. We both handle most of the underwriting. We sit down, go visit the property together. And then at that point is where we kind of diverge in our roles. And it's kind of happened gradually between the first and the second deal that we just mentioned. I'll handle mostly the debt, and Ben will handle the equity. And then we both manage the property pretty equally, meet with all the contractor appointments and dealing with the renovation.
Reporting and things like that. And I've been buying multifamily since 2006. It's just, this partnership is fairly new, about a year old. But, I've been doing this for a long time.
Yeah. So how did the partnership change from when you first started to now?
I don't think it has. we like each other, we trust each other, and our areas of expertise are very complementary in the way we look at things, and with the way we process things is very complementary. So it's just it fell in really, really good, and there hasn't been a need to change.
Well, what has changed is at the beginning we were both trying to do everything. And like I just mentioned, we kind of naturally took on the areas we were strongest at and kind of did our own segregation of duties just organically over the last 6 months.
So now you're just doing everything, Sam?
Pretty much. That's a nice way of saying I do everything.
Hey, somebody needs to look pretty while he does all of that stuff, okay?
So again, I do everything.
So how did you all determine who would be paid what in the beginning of your partnership? I've heard people ask that. Well, we're looking at partnering, and how do we structure that, and what should that look like, and how do we do that? Or what's worked for you all?
I'll give you a very simple answer. If people are concerned out of the gate about who's going to get paid for what, they're not looking at the right fucking thing. What they should be doing, figuring out how to underwrite deals, how to get taken seriously by brokers, how to get some deal flow, how to raise some money, Sam and I never even had a conversation about who gets paid for what and why. It makes sense. Like once things make sense, they make sense. They don't require a conversation. So like, I don't know, Sam, if you disagree with me or what, but we just never, ever talk. Look, I want a great deal. He wants a great deal. That's where our focus is to find a great deal. Everything else is going to fall in place if we have a great deal. All of this other nonsense is just nonsense. It's just like, you're going to focus on how much you get paid. How does that help you get a deal?
Yeah. And to be more specific, we split everything 50-50, but yeah, like Ben said, there wasn't really much discussion early on about how we were going to structure it. It was just, we just started looking for the deal before we worried about anything else. Because if you don't have a deal, what does it matter?
There was a discussion about, is this guy an ass? Do I even want to go there?
No, I appreciate that, and I appreciate both answers. But I know that I just get that question often. I've heard it myself, and so since you all are in this partnership,
that's a silly question. Listen, the reason most people don't make the money we make and don't buy the apartments we buy is because that's the kind of thing they focus on.
Yeah,
that's exactly the wrong thing to be focused on if you really want to be a player. This is what we're trying to tell you is like, yes, you're hearing this question a lot. And guess what? Only a few of the people you talk to are actually doing deals. How do those two things line up, right? The people doing deals aren't worried about stuff like that.
Yeah, and I agree. And if you both have that relationship that you're going to partner, then it's not a big concern anyway. It's going to work out. You can focus more on the finding the deal and the underwriting like you're talking about.
Right.
So, tell us a little bit about a recent deal that you all have closed on. Maybe the most recent one. Tell us, why you bought the property, what looked good about it, and maybe your buying criteria. Did it meet your criteria or not?
Ben, should we actually talk about Silvertree so we can talk about some results as well?
Sure.
So Silvertree we bought about 6 months ago. It was 98 units. We purchased it for $8.2 million, raised about 3.6 of equity. The rents I think were 600 when we took over, Ben, unblended.
Not quite.
Yeah, a little under 600. We're spending about $12,000 per unit to fix up the property. 7,300 of that is on interiors, but that's giving us a $340 rent bump per unit. So we're getting rents up to over 900. And that's kind of what you have to see in the Phoenix area is about a $300 increase. Go ahead.
Yeah. So mathematically, let's back it up and explain to folks why you have to see what you have to see. So Whitney, most of your value add is a function of filling up vacancy, right? In most municipalities, you go to Houston, you go to Ohio, Columbus, Cincinnati, you find that quote unquote mismanaged property, right? That's what we all want. We want that mismanaged property. Well, what does it mean mismanaged? Mismanaged means you've got some vacancy because the ownership doesn't want to deploy capital to bring units up to par. A lot. They're running at, 78% occupancy, 73% occupancy, 84%, whatever. And so when you take that over, majority of your value add is a function of going in, fixing what needs to be fixed, and filling up the vacancy, bringing it to 94%, 95%, whatever the market going physical vacancy is, right? That's the majority of your value add in most value add plays. And then you put some lipstick on the pig and raise the rents $50, $60, and you call it a day, okay? The problem in Phoenix that grows 1.5% in 1 year is that there's such a population explosion here and such a lack of inventory in $800 to $1,200 apartments that there's no vacancy. Even the most horribly run property is generally speaking operating at market occupancy. So what does that mean? What does it mean to buy value add in a place like Phoenix that's extremely high growth market in a county that is the #1 growth county in America? What does that really mean? What does it look like? Well, what it looks like is you have to actually do the value add. You have to actually create the additional revenue. There is no vacancy. When we took over Silver Tree, there were 2 vacant units out of 98. When we took over South Mountain, there was 1 vacant unit out of 117. There's no vacancies because there's just no vacancies because there's a lot of demand because of the population growth, right?
But we can't underwrite no vacancy. And
But
so
you
that's
can't underwrite no vacancy, right? So
I
you need
appreciate you putting that
value
in.
add. You need value add just to get, like the South Mountain, which just closed 3 weeks ago. I think the sub-market is annualizing at like 2.6% vacancy. The entire sub-market. Okay. You know, what do you do with that? You underwrite 5 or 6% vacancy because that's what is sustainable historically. But then you need value add to compensate for the difference between the 6% and the 2.4% in the marketplace right now, which is not sustainable. You have to assume it's not sustainable, right? So you need value add just to compensate for that and break even. And then you need a bunch more value add in order to actually make returns. So what it looks like is $300 per door plus. And that's the only thing that works in Phoenix because there's no vacancy.
And I heard your reaction when I said 12,000 per unit. So we're spending 7,500 on the interior, and we're basically touching everything in the interior of the units. Completely new kitchen, from cabinets, granite countertops, stainless steel appliances, plumbing fixtures, lighting fixtures, new flooring, paint, just basically touching the entire, as well as bathrooms.
Yeah, that's awesome. You can get the $300 rent bump. I mean, and is that, you know, by the time, well, I guess give me your timeline on far as how many units is it and getting it all renovated?
Well, let's talk about the Canyon, Sam.
Yeah. Well, so what we do is we're on lease renewals, we are bumping rents quite significantly. So say $250 rent bump. That naturally gives you people who are going to move out and not renew them. And so we did that just enough. We figured out how much we would get so we can get 5 to 6 units available per month that won't renew. And then we go in and fix those up. So, and that really helped us in December and January, where I think we had, was it 39 lease renewals between those 2 months? So 39 out of 98 units in 2 months. So heavily weighted on those 2 months. And we obviously couldn't renovate all of those units. So we went in, just increased rents, $250. And a lot of people were willing to accept that. But we had 5 or 6 people said, we're not going to accept that. And that was perfect. We got our hands on those units. We were able to renovate. And then we still got a ton of loss to lease that we captured on the classic renewals.
So will this property be, an A-class property when you're done with it?
No, it's not going to be A-class property.
It's still at 86 construction.
Okay.
Yeah.
They just hadn't been touched since 1986. But it's right near Grand Canyon University. They're growing significantly. In the last 10 years, they went from a few thousand students to up to over 20,000 now, and they want to be up to 30,000 in another 5 years. And they don't have the housing for that many students. So there's quite a big shortage right now. So our biggest goal in there was pulling in some students in to get our rents up. But surprisingly, we haven't had to even market to students yet. It's been our current tenant base that has just appreciated a higher class of living and is willing to pay the $350 increase in rents. We've actually had some people that were so low in their rents that they've doubled their rent from $500 to $1,100.
Yeah, the property was just so there are still deals. There is still value add. There's still opportunities. All of this nonsense I keep hearing all over the place that everything is traded 5 times since 2010. Yeah, this is true for most things, but not everything. If you're willing to do 1 deal a year, 2 deals a year, 3 deals a year, and you're willing to wait and look, there are still opportunities. There are still deals.
But what helped us get those increased rents right on the current lease renewals and where we're not touching the interior of the unit is they see what's happening elsewhere. So right when we took over, we painted the property, we rebranded it, new signage, we spent $70,000 in landscaping. They see that we're redoing the pool area, we're adding a gym, we're redoing the laundry, and they see all that. And so even though their unit's not getting renovated, they're fine paying an extra $250 And then in a year from now, when their lease comes up again, we'll have to take over their unit to finish our business plan and actually improve and renovate their unit. But in the meantime, they're okay with paying the extra because of the amenities they're receiving.
So what is the business plan? How did you all structure this deal? What's the hold period? What's your plan?
Man, he wants to know all the secrets. He just wants to know.
Right.
Do you know how
An
much
open book, man.
I'm going to send you a bill when we get off of this thing, and it's going to have a big number on it, not just a little number. I'll put the gurus to shame in the bill. I'm gonna write it out right now. Here's a pen.
The deal was what, 3 to 5 years is what we usually tell people to expect. We underwrite to 10 years though. We are higher in a cycle when we're late in a cycle. Nobody knows how long that cycle is going to last. So we underwrite to 10 years in case we have to hold through another cycle, and that way we can exit when we want to and not when we're forced to.
But the exit is a moving target, because the exit is a function of a relationship of the return to risk. So how much can I maximize the return and at the same time take the risk off the table? So we would consider selling, and it would be an attractive proposition for somebody, not for us, because we're a different kind of investor. But for somebody, it would be an attractive proposition to take this property over in about 6 months. We're going to have 50% of the units done. We're going to have the rents proven, and there's going to still be good amount of meat on the bone. So for somebody who's looking for a long-term hold for a cash flow play, so the reason I'm telling you this is because in another 6 months, we're going to continue, we're going to consider an exit. Now, our multiple is going to be lower, but obviously our returns in terms of cash and cash IRR are all going to be higher because they're timed a lot sooner than anybody anticipated. Okay.
And the advantage to doing that is you get an investor that they have meat on the bone. You're doing a proven value add, and they're willing to pay a lower cap rate. And so you have to weigh that lower cap rate versus the higher cap rate with additional income by finishing the renovation and the longer time frame, and weigh those two and see what's your better exit. And so we're actually constant communication with the broker who sold us the property on when we should time this exit, testing out the market, seeing how many we should renovate, if we should complete the renovation ourselves.
Are you a new or experienced investor wanting to learn how to have a successful syndication business? Learn from the nation's leading syndication expert, my friend Vinny Smile Chopra. He has created a multifamily academy where you will learn everything about deal analyzing to selecting emerging markets, managing assets, and much more. In the academy, you'll find over 500 lectures and templates to help you run a successful syndication business. Your membership also gives you access to Vinny every Wednesday through masterminding and coaching calls. Vinny came to the U.S. with only $7 and now is a CEO of 5 companies, acquiring and managing a portfolio of more than 3,500 units. He's completed 26 successful syndications ranging from 50 to 500 units and created a portfolio valued over $200 million in commercial real estate. He built the academy to teach and mentor investors like you to succeed. To learn more about the Multifamily Academy, text LEARN, L-E-A-R-N, to 474747 or call his team at 925-766-3518. I really like how you talk about exit. The exit is a moving target, and it's not just like, oh, it's 5 years from now, or oh, it's 7 years from now. Oh no, it's a moving target. I really like that how you said that. But just keeping your options open, right? Because you don't know what the market's going to be 5 years from now, and up to 10 years. That's awesome. So how did you structure it? I guess what type of split, what kind of projections did you have in the beginning, and what does that look like?
Well, we don't touch anything that doesn't underwrite to mid-double-digit IRR on a 10-year hold. And it's not because we intend to hold for 10 years, but in case if we have to, we still want to be able to underwrite about 14 and a half, somewhere in there on the IRR. On a 10-year hold, that's about 2.5, 2.6, 2.7 multiple. On a 5-year, that same deal will produce somewhere between 16 and 16 and a half IRR, and it'll give you about a 2 multiple on a 5-year. the preferred exit is 3 to 5. Underwriting is, of course, incorporates 10. Preferred exit 3 to 5 means we're going to stabilize the property. We're going to show 12 months of stabilized annualized financials, T12 basically, that's stabilized, and then we'll get out on a stabilized number. However, an exit is possible on a proven value add strategy. If there's enough meat on the bone for the next guy, this can work very well. And so that's something that shorter than 3 years, we would also consider. Okay?
And the biggest reason we also want to consider that is there's a lot larger pool of buyers in this cycle of value add buyers than there are stabilized asset value buyers.
Correct.
No, that's a great point. Understand who your buyer is before you get to your exit.
Absolutely. And then regarding split on your question, 70-30 split on that one. After an 8% preferred. So pretty standard what you're seeing in Class C value add multifamily syndications right now.
So what's been the hardest part of the syndication business for you all, up to this point?
For me, it's fiduciary. I've worked with private money, private loans for, over a decade. Okay. And I was always okay with it. I trusted myself. I felt I understood what I had to do. I borrowed people's money. At times, other people, I lost money, but other people didn't lose money. Whatever. All of those dynamics, be as they may. The syndication, though, you start taking millions of people's money. That's no joke. And for me, I had to get over myself a bit to get comfortable with that idea. And the only reason I can get over myself is because I'm so good at this. It's my highest and best use. If I wasn't doing this as a man, I'd look at myself in the mirror and I'd say, what is it you're supposed to do in thy life? And I wouldn't have any other answer. Because this is the thing. This is my thing. I've done it for so long. It's what I know. It's like before this, I was a violin player. It wasn't just who I was or what I was. It was also who I was. So it's the same kind of thing. What else am I going to do? This is my thing, right? That's how I make a difference, how I move things around. So you can't have both. You got to sit on this chair and sit in this chair. If you're going to do this, you got to somehow accept the responsibility of people's money. But it's a heavy load to carry. It really is. But that to me was the hardest thing to wrap my head around.
What about you, Sam? I know besides partnering with Ben, what's been the hardest part of this business?
I think it's by sticking with your guns, especially in today's where there's not a whole lot of good deals. We get sent a lot of deals that brokers will try to convince you can meet your expectations. And it's just continually saying to them, no, I'm not going to lower my standards on on my buying criteria. And I mean, we actually don't have that hard of a time. Like Ben said, he takes the responsibility pretty serious. But there are times where a broker's telling you, hey, this is a nicer area. You can spend a little bit more because your exit's going to be a little bit more. People are paying a lower cap rate in this area. But the exit just seems cloudier in certain situations. This is a conversation Ben and I had last week with a broker. When you start getting closer to new construction prices, you have to draw the line somewhere. I'm not going to be able to exit. I'm going to have to hold on for a lot longer. When I'm starting to approach those new construction prices, nobody's going to buy 80% of new construction now on Class C property.
And it's very tricky, though, Whitney, because, one of the few instances I agree with Cardone, right? Cardone says, don't buy if there's cranes in the air. Well, he also says $800 to $1,200 rent. He's right. This is what most Americans can afford. And this is the case in Phoenix just as well as anywhere else. Well, there's a lot of new construction coming online, but that needs to be between $1,400 and $1,800 a month to begin to make sense. And then it goes up from there. So in dealing in C class, you're kind of dealing in a scarce commodity because it's not easily replaceable. Okay, which is why we like C class. I don't want B class that competes with A class. What the hell do I need that for? I want C class that is never going to be as nice as B class, but it's going to be nice enough for those people who can really afford it. And there's the majority of people are in that category, right? And so, but the rationale, because in real estate, everything is convoluted to a certain extent. The rationale for the brokers is very easy to make the argument that because it's not easily replaceable, it's almost fair to look at it as a new construction. Because if you were going to replace it, you'd have to replace it with new construction. Well, the numbers just don't work. I see how the rationale backwards and upside down can kind of work, but the numbers just don't work.
That doesn't help you, does it? It
doesn't help me. Maybe it helps somebody else. Maybe it helps a newbie somewhere, but it doesn't help me. And so one of the criteria for us is to keep an eye on our all-in per square foot pricing and to know what our delta is between that and the new construction, because that's really, in the downturn where your safety margin is going to lie.
And so what is we're running low on time, but what is a way that you all have recently improved your business that we could all apply to ours, and maybe, lay out a couple of key things in the syndication business that we should all be doing?
Sam?
So one thing that I can think of is we're trying to systematize it so we can handle a lot of properties at once. So we were doing asset level accounting on top of the property management accounting that the property manager does. So I'm working right now with the financial reporting people at our property manager to push that accounting, asset level accounting, to them, where they have access to our bank accounts at the investment level. So they see all those transactions, and then they just go ahead and add them into their financials, and there's not two levels of financial reporting. And just simple things like that, I feel like, is our best things that we can do now so we can grow our business. Because dealing with stuff like that on a monthly basis is just not the highest and best use of our time.
Yes, you're outsourcing. You're giving those jobs to other people that can specialize in those things so you can focus on something else.
Yeah.
Right. But at the same time, we're not really growing a business. See, and I think Sam and I agree on this. We see this as an very opportunistic kind of thing, because once you start systematizing it, a system is a machine, and you have to feed that machine in order for gears to continue to turn. Because if you don't feed it, then the gears stop, and then they get rusted out, and then you start it up again, and it doesn't work right? So we're not, there's so few good deals that we don't want any of that moral hazard of doing a deal just because we got to keep the gears moving so they don't seize up.
So to give you concrete of what Ben's saying is, say if I have 5 employees and I hire someone to do that accounting for me, then I have to have deals coming through to support those employees that I hire to do this. And we don't want that moral hazard of saying I need to just get a deal to have employees. So we were looking for ways to have a third party do that. And our property manager didn't offer this to us. We approached them to see if there's something that they'd be willing to do. And luckily they were.
But having said that, when you say property manager, guys manage 20,000 units. These guys, as professional gets. They have a legal department. They have an accounting department. They have a construction arm. This isn't your mom and pop around the corner has 300 units under management and we're going to trust them to do this. No, it's not like that. Okay. But that point I was making is an important point. This isn't a business. It's an opportunity play. Here's a deal that's really good. Let's do it. When's the next one going to be? Hell, I don't know. If it never happens again this year, I'm good with it. We just do the deals that are really we're comfortable doing, and we won't do anything else. So from that sense, in that standpoint, we don't want to be vertically integrated. We don't want to have all these stations of people that have to get paid. It's why.
Yep, I like it. I like it a lot. It makes sense. And then if you had to, you could always you could start doing the accounting again or doing that task again if you had to.
Right.
So what's the number one thing that's contributed to your all's success?
To me, I would say finding a partner. Absolutely. I think Ben and I both agree we could not be doing this alone.
Absolutely. I'll tell you, I tried. It sucked so bad, I couldn't even tell you. It's doing this on your own with everything that has to be done. Absolutely. In this case, partnership is a blessing.
No, I appreciate that answer a lot. I've heard that time and time again. Some people are afraid of giving away part of their business while, others say, no, it's quadrupled my business, just by having one partner.
Absolutely.
Yeah. And so how do you all like to give back?
We did PSW. We did the Phoenix.
Tell us about that.
In 2019, we're doing again in 2020. We donated 20% off the top to nonprofit, which was really cool. It was a good, gratifying feeling. It all goes back to my wife and I donate quite a bit to begin with, and she donates her time, volunteers, and things like that. You never feel like you do enough. No matter how much you do, it never feels like enough. And so one day I sat down and I said, well, how can I incorporate that charitable giving inside of a business infrastructure? So the more money I make, the more money the charity makes. So there's no conflict of interest. It's like everybody wins. And I'm motivated to do better because I will do better, but also the charitable giving will do better. And that's when, I called Sam and I said, what do you think about this idea? Everybody's asking, how do we learn what you guys do? How do we learn the underwriting? How we do this? So why don't we do an event and we'll just donate a portion of the income on that event? And it worked out perfectly. And we had a good time and we made some money. We didn't make as much money as the charity. The charity actually made more money than we did, by about margin of 100%, actually. That was good. That was good. But we met a lot of good people. We did a lot of good. We did, we made a donation. It was good.
Do you all know when the next event is?
It'll be January of 2020. So we're just going to do an annual event. At the last week of January.
Awesome. And just briefly tell us again what that event is and what they're going to learn at that event.
So we did a 2-day event. I'm actually considering a 3-day event in this case. But the first day we spent the entire day in classroom. Like we projected the spreadsheets up on the screen. And we charged a considerable amount, $3,000-$4,000 for people to be there, but there was no upsell. We had nothing else to sell, right? We had no other mentorship program. We had nothing. You want to come learn. And for this kind of knowledge, you're going to have to pay a little bit. I'm not giving this out for $200. Sorry. So the first day was whole day of underwriting. Just line item by line item, just going through everything and discussing, and both Sam and I on stage, and just different perspective on each number and every line item. And then day 2, we did property site visits. So once they understand the numbers, they understand what we saw before we bought the thing, where the thing is now you can go touch and feel it and see what it really looks like in reality for those numbers to be dynamic. In people's perception.
And on the second day, we also heard from some professionals. So we had our team members out there. So we had our property manager, we had our broker, we had our mortgage broker, we had our SEC attorney, which is really popular, Jillian Sidoti, came out and spoke to the group. And hearing about those professionals, how to build up that team, I think was one of the more useful things at that event.
That's awesome. I wish I could have made it to the event. I hope the listeners are paying attention and will be looking for that as well. Tell the listeners a little more about, how they can learn about you all and what you're doing in this event, how they can know about those things in the future.
Sam? I told you in the beginning I was going to be Mr. Gentleman today. You go.
I've never seen you so passive and just hand off the mic. So you can reach me at whitehavencapital.com. And then for the event, it's phoenixsyndicationworkshop.com. And we are also going to be launching a podcast here pretty soon, basically walking through everything with multifamily syndications, called Multifamily Syndication Unscripted. And I don't think, what's the URL for that, Ben? I actually don't know that.
Did we buy a URL?
Yeah.
Somebody's buying it right now.
Yeah.
So, well, just follow us on Facebook. My email is ben@justaskbenwhy.com. My website is justaskbenwhy.com. It's been that for 15 years. So if you've been on Bigger Pockets, you know probably what my website is. We're very excited to launch a podcast. It's going to be very, very different from most podcasts. It's not going to have guests. It's going to be roundtable. In fact, it is, because we've been recording them, and things are turning out very in-depth and very, very, very cool. Now, you're still not going to get to internalize everything until you see those spreadsheets. And we have a 30-minute discussion on every number. It's very difficult to kind of teach all of that information, but the podcast is really meant to teach, really a deep dive on everything to do with what we do. Very cool. We're pre-recording everything, and we're going to dump the first season, the whole season all at once. Kind of a different model.
Kind of like a Netflix approach.
Yeah. Awesome. Well, Ben, Sam, I really appreciate your all's time and the value you've provided and being on the show today. I hope the listeners will reach out to you, and I hope they'll go to LifeBridge Capital and connect with me, and go to the Facebook group, The Real Estate Syndication Show, where we can all learn from experts and grow a business together. And we'll talk to each of you tomorrow.
All right. Thanks for having us, Whitney.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.